Well, stocks taking a leg lower as well on that 30-year auction. When it comes to the markets, though, my next guest says tariffs have not translated into meaningful inflation thus far. And the real story remains earnings. Joining me now is John Porter, Chief Investment Officer at BNY Investments, Newton. And John, it's great to have you on. I mean, we get a CPI read next week. We've heard some commentary about companies factoring in tariffs to their outlook. Do you think this is the worst we're going to get in terms of some of that tariff impact here? I mean, what happens if it doesn't actually translate in a meaningful way in the inflation data?
I think that's a key question, Morgan. Thanks for the opportunity to chat with you. But look, inflation and concerns about the impact of tariffs on inflation has been and continues to be a key issue in the market. I think as we've seen, as we've gone through the second quarter earnings season, which, as you mentioned, has been a strong one, we've seen that, by and large, companies are doing a very good job navigating, this ever-changing tariff landscape. And let's be honest, this is what corporate executives are paid to do. They're paid to navigate through turbulent times. And I think by and large, they're navigating through it well. We don't want to be complacent. We don't want to declare an all clear yet. But I do believe the weight of the evidence is at this point, tariffs are not going to cause a meaningful uptick in inflation from everything we've seen to this point.
Okay. We've seen some softening data in the labor market. We've seen the market swing pretty dramatically to expectations that we get a cut in September. We've also seen Fed officials this week turn very dovish. Even Janet Yellen did an about face on CNBC in her interview yesterday morning. What does that mean in terms of investing here?
I think it means you need to prepare for a rate cutting environment. I think it's for a while, it's been a when, not if we're going to get rate cuts. And I think the jobs data that came out last week really, probably all but cemented that most likely in the next Fed meeting, we're going to start to see a rate cutting cycle. The question is, are they doing this too late, or are they doing it in a preemptive fashion? Everybody's focused on the jobs market right now, as they should be. It's so key to the underlying health of the economy. At this point, I would say the Fed has been prudent in being restrained in cutting rates. But I think the time for rate cutting is soon, and it's because we need to protect the job market, which is so crucial to our economy.
Okay, so what do you buy here? Name some names for me.
I buy Google. I think everybody loves the AI trade, and I think Google is a very underappreciated play on AI. Look, it's a difficult stock right now. There's a perception that the ChatGPTs and so forth are gonna impact their paid search business. And, I just think it's two different business models. I think the commercial element of Google's paid search business is going to continue to be one of the most robust businesses on the planet for a long period of time. So I'm not fearful that there's going to be a meaningful slowdown in the paid search growth, but the market's really concerned about it. And that's why it's only trading at 17 or 18 times earnings. I happen to believe that Google is actually one of the best positioned companies to benefit from AI, which is so data dependent. So I'm excited about Google here. Even it's run a little bit recently, but I think at this valuation, it's very compelling.